Intel had been priced as a company losing the semiconductor war, slowly, then all at once. The consensus entering May 2026 was clear. AMD was taking server share. TSMC was the foundry of choice for every major chip designer, and Intel's dual failure in both manufacturing and market share left it structurally disadvantaged. That thesis did not just have bears behind it. It had the earnings trajectory, the market share data, and the capital flows all pointing the same direction. Then, on May 16th, INTCs surged 15% in a single session on news of an Apple chip manufacturing deal. The question that 15% move forces is not whether Intel won a contract. It is whether one contract is enough to break a multi-year displacement thesis that institutional money had already bet against. The Apple deal matters to the thesis for a specific reason that goes beyond the revenue. Apple choosing Intel as a manufacturing partner signals that Intel Foundry Services is now considered a credible alternative to TSMC for at least one tier of production. That is the structural implication the market repriced on May 16th. Not the contract value itself, but what the counterparty's identity says about foundry viability. Apple does not award manufacturing contracts to foundries it does not trust to execute at scale. The prior thesis rested partly on the assumption that Intel's manufacturing process was too far behind TSMC to attract top-tier design customers back. The Apple deal directly contradicts that assumption, which is why the short covering pressure on May 16th was immediate and forceful. But the repricing raised its own unresolved problem. INTC had already rallied 491% from its lows before the Apple deal was announced. The 15% move on May 16th was not a discovery of value. It was capital that had been short or underweight being forced out of position by an event they had not priced. The CPI print the following day wiped 8% off the stock, pushing it back to $119. That sequence, 15% surge, 8% reversal in 24 hours, does not describe a stock in price discovery. It describes a stock where the participant structure is still deeply contested and where the Apple deal shifted the narrative faster than fundamentals could follow. The displacement thesis has been challenged, but the challenge has not yet been confirmed by the operating metrics that would make it durable. The institutional positioning data is where the displacement thesis gets its most complicated reading. More than 2,000 institutional investors added INTC to their portfolios in Q1 2026, before the Apple deal was announced and before the stock's most recent leg higher. Tiger Global, the $78 billion hedge fund, initiated a new position worth $72.3 million as of March 31st. Northern Trust, Neuberger Berman, and NetLife Asset Management were among the names entering alongside Tiger. That is not a retail-driven momentum trade. That is a coordinated institutional reassessment of whether the displacement thesis was already priced in at prior levels. The counter signal in the same data is what Tiger did simultaneously with its Intel position. Tiger boosted its stake in Taiwan semiconductor manufacturing by 49% in the same quarter. That is not a bet against TSMC. It is a bet that both the incumbent foundry leader and the recovering challenger can win simultaneously, which implies Tiger's Intel position is not a displacement reversal thesis so much as a valuation gap trade. At the price levels where Tiger entered, Intel was pricing in a scenario more bearish than what the Apple deal subsequently suggested. The institutional accumulation in Q1 was less about conviction in Intel's structural recovery and more about the gap between the stock's priced-in outcome and the range of plausible outcomes. What the Q1 positioning data does not show is the hedge fund manager who made the most deliberate structural argument. Stanley Druckenmiller bought INTC in Q1 2026, while explicitly avoiding Nvidia. That choice carries a directional implication that is harder to dismiss as a valuation trade. Druckenmiller's avoidance of Nvidia while accumulating Intel suggests a view that the AI chip cycle's best returns have already been captured in Nvidia, and that the next repricing event in semiconductors runs through the names that have not yet fully recovered. The position pressure shift that made institutional accumulation rational in Q1 was Intel's compressed multiple relative to the broader semiconductor recovery, but Druckenmiller's Nvidia avoidance adds a relative value dimension that the valuation gap framing alone does not capture. What neither the Tiger position nor the Druckenmiller position answers is whether the server market share data, reported just weeks later, changes the calculus for the institutional holders who entered at lower levels.
Nvidia's Q1 FY27 results, reported on May 21st, introduced the sharpest challenge to Intel's repricing that the Apple deal narrative had not addressed. Nvidia posted $81.6 billion in revenue, of 85% year-over-year, with data center revenue of $75.2 billion. The revenue scale is not the threat to Intel, the product roadmap is. Nvidia explicitly stated it is vying to become a leading CPU supplier, with Vera CPU racks positioned as a direct competitor in the server CPU segment. Intel's last defensible stronghold is server CPU dominance, and that is precisely the market Nvidia is entering, with the resources of a company generating $91 billion in quarterly revenue guidance. The server CPU market share data, reported by UBS, confirmed that the erosion was already in motion before Nvidia's CPU ambitions became public. Intel's server CPU share fell to 54.9% in Q1, a 370 basis point sequential decline, with AMD and ARM gaining ground simultaneously. Citi's estimate that the total server CPU market reaches $132 billion by 2030 is the correct frame for understanding why that share decline is not abstract. Each percentage point of server CPU share at $132 billion in total market represents over $1.3 billion in annual revenue at stake. Intel entered the Apple deal repricing week with a manufacturing narrative improving and a server CPU narrative deteriorating, and the Nvidia earnings report sharpened that contradiction rather than resolving it. The detail that most participants who bought the May 16 surge have not fully accounted for is the timing asymmetry between when Intel's foundry recovery becomes revenue generating and when Vera CPU racks begin capturing server CPU market share. Apple manufacturing revenue from a new foundry relationship takes quarters to ramp. Nvidia's server CPU positioning is already backed by relationships with hyperscalers, who are spending $91 billion per quarter on Nvidia infrastructure. The Apple deal buys Intel time and credibility in foundry. It does not slow AMD's share gains or delay Nvidia's CPU entry. Intel's repricing is durable if the foundry recovery generates enough cash and customer diversity to fund the CPU defense simultaneously. The monitoring variable for that thesis is not the stock price. It is whether Intel's server CPU share stabilizes above 50% in Q2 and Q3 as the Vera CPU racks begin entering procurement conversations, which is the specific threshold the May 16 move has not yet priced with precision. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.